Hello, my name is Dr. George Mochocki, and welcome to Finance 225. Today we'll be covering Chapter 10, Measuring Exposure to the Exchange Rate Fluctuations. Basically, if I look at the exchange rate and how it fluctuates, how much exposure does my currency or the currency of my subsidiary has an effect on the overall value of the MNC. Remember, we're going to be looking at it from the MNC, multinational corporations perspective, looking at a macro viewpoint, looking at different governments, different effects that exchange rates in this case we're going to be talking about. All right, so you make sure you read the book. You open up my concept maps, my mind maps. You have them to the second tier. You read it, and as you're reading it, you take notes using my mind maps. It gives you the vocabulary that's important. It follows along with the book from the author, follows along from the author's student PowerPoints that's in there. So it gives you, it takes like 60 slides or 40 slides and condenses it into 2 sheets of paper, so it's easier for you to study, to learn it. In this course, you're going to be doing some math problems. I'm going to change this a little bit. I'm going to have some examples, the chapter end questions, and I'll answer it right away on here to give you a little more flavor in here. Last chapter 9, I used some YouTubes from somebody that says MBA BS or whatever, but he right to the point, very simplistic way to understanding it. Once you understanding it, it makes it easier. What this is, after you read it, we've discussed these chapters, transaction exposure, translation exposure, and different exposures, economic exposure. All these have an effect on the what do you call it, exchange rate. What's the value of the money? If we read what's going on in China, I was looking at China devaluated its yen, and basically when it devaluated, it means now its goods are cheaper over there. So is that really being in a fair market when they make remember, the government's factors that economically have an effect on the exchange rate, indirectly or directly, that we've covered in previous chapters. So this is going to be a summarization. You read it, we discussed it, you did the homework problems. Your exams are going to be mostly on concepts and strategy. I'm not going to be worried too much about the math. You'll get that as you go on. Right now you're learning a new vocabulary, and you're learning international finance, the terms and conditions, the ask, the bid, forward rates, discount rates, premiums. Oh my goodness, what's all that? And that's everything that you've learned in regular corporate finance and accounting. Now you're just taking out into the international arena, so you understand what are some of the ramifications going forward. Okay, so now this week I didn't do anything with the webs, because you've got the other sites that were kind of good. You've got the business for international settlements. You had the Federal Reserve site, in New York. If you look at that district, there's everything else outside. So you have a lot of different ways of looking at different graphs. Remember, the graphs, there's no way I could cover everything in an hour. I'm trying to keep it underneath an hour, and I'm really just striving for that. So I'll be kind of more reading off, just kind of word for word. Stop it, think about it, and go forward. Remember, this is a summation. You already read it. We discussed it in an online class that you have me at Harper College, or in a face-to-face class, and this is a supplement to it. Online, this is your lecture or flip the classroom. So remember, now you're looking at, what did I miss, or what I should be. And again, I have more verbiage here than I would want you to have in the concept maps. I would for my own mind maps, but I just want this so it flows easier for you. It's a transition for me from taking you to learn how to do taking notes, just writing it down logically. This way you could look at it from all avenues. You could see it. You see the whole picture, and zero down to the micro, to the smaller picture. Okay, so what's relevance of exchange rate? And I got them marked down here, and I broke this down here. So we're going to talk about all this, exposure to the MNC, and I think that we have two more chapters, and we're going to go right into the corporation, the micro. That's maybe a little more on hand. It'll be easier to relate. But for you to be able to function in the micro, or from the business perspective, I have to understand the environment that I and other investors or companies are working in an international finance environment. Okay, so reference of risks exchange rate. Remember, exchange rates, I need it because I'm doing outside. I got to have the currency in that country. So let me just close this. Okay, so let's see how I have it. three forms, and I have it large enough. Read it, stop it. If I'm going too fast, slow it down or turn my voice, and just let students will stop it, and then they'll write onto it. The more senses you utilize, you hear me, you're reading it, you're speaking on your own voice, you're reading out loud or in your mind voice, and you write it down, the higher probability you remember this. Okay? Three forms by which MNCs, multinationals, are exposed to exchange rate risks is a transaction exposure, economic exposure, and translation exposure. I'm going to talk about those three. Each firm differs in degree of exposures, the exchange rate. Why? Every firm is different. A firm should be able to measure its degree of each type of exposure, as described in this chapter. We're going to show you how you measure the different ones, and I have some examples. This one I'm going to do some problems. I'll read them out loud, stop it, I'll let you study it, and then you go forward. Then I can decide how to cover that exposure. Once I know what's the risk, that's why I'm going to hedge it. I need that currency now, but do I think the currency is going to be devaluated? I'm doing some, I got operations in China, and now they're devaluating the currency, so is that good for me? Right, if I'm importing, I could get more goods, but I want exporting. So you have to look at it from the thing. Am I investing the capital investment inside there? Am I going to try, like we talked before last chapter, or I'm going to try to do short term? I can make some money because I already did a future contract, and I've got the discounts on that. I don't have to pay any premiums. My premium has already been paid off. At my break-even point. So all this makes a big difference. Okay, so but now the exchange rate. So what money do I have? What denomination do I have? Is which money is going to give me more return into that subsidiary, but that subsidiary isn't adding value to the whole MCN. Remember, the whole thing is the whole MCN. It's not like it's like a big corporation. Every department has to look for the ultimate goal to make sure that corporation is successful. Not that this department is successful, but everyone else failed because you did something to hurt the other departments. You have to work as a whole. And so in MMC, everything that's happening there, sometimes some are losing, so the other ones are picking up the slack, for lack of a better word. That's the beauty of diversification when you're looking in the global environment. But the beauty of that, you have to be able to understand, when do I move the money? And remember, you don't have like a fortune right now. You don't have time travelers, as I tease, but you have to do your best. And none of these theories are 100% foolproof, but you feel comfortable in some theories versus other theories, depending on your strategy and depending on your knowledge and your comfortability and your intuitive critical thinking. Remember, not just guessing, intuitive critical thinking. This makes sense, and it's kind of like leading you in the right direction. Okay? And how can I decide to cover those exposures? Exchange rates are extremely volatile. All right. So if I'm looking at, let me see what I got here. Okay. So like I said, as the exchange rates are extremely volatile, the dollar value of the MSC future payables or receivables. I should get rid of that. Let's see what the other sentence is. Okay. Remember, looking at this, stop me. In the foreign currencies can exchange substantially in response to the exchange rate movement. So the dollar, payables and receivable could change depending on my, inflow, exflows, depending on the currency and the volatility of that currency at that time. Okay. And here's an exhibit. If I'm looking at the different amounts of dollars needed to obtain import transactions, 1 million euros. And you see how it's changed over time. July, higher, lower. So when you're looking at the graphs, stop and look at it. But you're looking at the dollar at certain periods more volatile than other periods. It's more unstable, for like, I don't say unstable, but a lot of activity going on, a lot of forces, so it's going up and down. It's like, oh, when it's going to settle down, and it goes up, it goes down. It could go in a very short time period. Always look at the time period. Okay, all right. So you got that. All right. Now, here's something to look at. The investor hedge argument. Here's argument. Exchange rate is irrelevant, but I'm looking at the exchange rate because investors can hedge. I'm either go one extreme to the other extreme to find that balance, but sometimes you're not right. Exchange rate risk on their own. Okay, that's the investor argument. you know, let's see, class topics discussion, discuss in general. What do I put that in here? In general terms, how you would measure the transaction exposure of a particular MNC. Remember, you're going to be doing this for your final paper. You'll be creating an MNC, and you're going to have to describe in some terms how you're going to measure your exposure. What is the relationship between the transactional exposure and economic exposure? And the last one here, I should have had that above. A small firm in New York produces various metals and sells them to local manufacturers. Okay, that's a question. It has no foreign sales and purchases all supplies and materials locally. Does transaction exposure exist for this firm? Does economic exposure exist for this firm? Those are two questions when you go reading on here. So I'm just trying to put that in here. I should have put this up here a little bit. Let me see what we have here. Look, I'm working on this class. Let me just go up here. It should have been right here. There we go. Okay? All right. So now we go. Now, so we got the investor hedge argument. They could hedge against it. So it should be a concern. Just an argument. Remember, you have to look. Remember, as a financial officer or manager, you're looking at minimizing risk. And part of minimizing risk, what do I have to do? Is it going to go up or down? I'm just looking. I'm looking in the short term. What's my period? And remember, a lot of things are going on. There's a lot of things going on in the market. You don't know what to do, so you're just going real quickly. You don't make too many moves because it's costing you. There's always a cost for any kind of thing. Any kind of transaction going on there. Okay, currency diversification argument. The U.S.-based MNC is well diversified across numerous currencies. Its values will not be affected by exchange rate risk. What do you mean I can just move money from other currencies to the other if I have it in the right time? Okay? A stakeholder diversification argument. If stakeholders are well diversified, they will be somewhat insulated. Somewhat. Remember, somewhat. Doesn't mean that nothing's guaranteed. This is like gambling. And I don't want to say gambling. It's more, it's risk. How do you, anything can happen. A lot of things could happen. That's why you take insurance. I may never get in a car accident, but I have insurance just in case the vulnerability that happens, I'm covered for whatever reason. That's what's minimizing risk. That's what risk management is, right? But somewhat insulated. So I'm doing the best I can against losses due to MMC and exchange rate. Okay, so now here's some responses. Many MMCs attempt to stabilize their earnings with hedge strategies. Okay, let's just do this with hedge strategies. I'm sorry, let me go back here. We're live here, so remember, as I'm doing this, I'm working on this, recording this, and talking just like I'll be in the classroom. I gotta adjust this. Okay. So we have that, and here's the question. Because they believe the exchange risk is relevant, because, and here's some quotes, okay? Because we manufacture and sell products in a number of countries throughout the world, we are exposed to the impact on revenues and expense movements in currencies exchange rates. Procter Gamble. Okay, so that's what they look at it. Increased volatility in foreign exchange rates may have an adverse impact on our business results from financial condition. Pepsi. You have to understand the exchange rate. You've got money coming in there. How much of my money and what money do I pay and what's it worth? Is it inflated? Is it deflated? What's China doing to money? Underinflated and devalued it because they want to stimulate the economy by more exports, and now the goods are cheaper than the U.S. products. So how are we ever going to pay? Okay, but now we got money, so maybe we could pay off more of our debts because the dollar is worth more. So you have to look at it from two perspectives. What are they doing? Are they going to trying to find that cushion, not to give away too much, but not to take away? That's the international finance. That's the beauty. And now we're only looking at one country. Now look, if I'm a multinational, I got European Union, I got South America, I've got other places. I've got India. That's part of the Asian market there. Another 1 billion people out there. What the heck is going on? Okay, so that took care of the risk. Okay, so now let's go on transactional exposure. Okay, definition. Due to international transactions, that should be one word, transaction by a firm, sensitivity of the firm's contractual transaction in foreign currencies to exchange rate movement. Okay, so it's very sensitive to the contractual transactions between the exchange rate movements. Real easy. Okay, assessing transaction exposure. If I'm estimating the net cash flow for each currency, and these are just exhibits, I'm not going to look at, just look at them I just open them up. So what I want you to do, go on there, hit the pause button. Now look at it. Oh, what does he have here? And then go forward. Okay? All right. So we have that and that. Okay, transaction based on value at risk. Or not variance, value at risk. The VAR, value at risk. Okay, so what does that tell me? And here's my value at risk. Measure the potential of maximum one-day losses. Let me just close this off. On the value of the position of the MNC that's positioned to exchange rate movement. Okay, no problem. Applying the the value at risk to time horizons. The value at risk. I'm trying to get you to look at this new thing. You're going to see that VAR, not variance. VAR, what the heck? Value at risk. The standard deviation should be estimated over the time horizon in which the maximum loss is to be measured. Okay? Now, applying the value at risk transaction exposure to portfolio. Remember, this is a summarization. You already read it, so you're looking at that. The MMCs are commonly exposed to more than one currency. Oops, sorry. Let me just get this back in here. Remember, I'm looking at that, or just turn it off, write it out. Are commonly exposed to more than one currency may apply the value at risk method to currency portfolio. When considering multiple currencies, the software packages, there's no way you're going to do that. You can be there forever. Put the numbers out. You're looking at the bottom line, but you have to understand what parts of the equation relate to what when you get that answer out there. Is it an increase? Is it a good? Remember when you look at that line, LRB line, is it on this side? What point is it on? Is it appreciation or is it depreciation of the currency, the exchange rate? Okay? Which basically is currency as you're looking at. Look at the currency as a commodity. You got something in there. Is it making money? It's basically a money, but it's a commodity. It replaces something that I could get for something. I could get some services for it. Or a gross domestic output of a country. Okay? All right, so we have that. Now, factors that affect the maximum one-day loss are the maximum one day. Here's the equation. Expected percentage change for the currency for the next day. Confidence level. Okay, standard deviation of the daily percentage change in currency. Formula, look at it. If you don't have it, you may just see the formula. It may not make you solve it. You're doing a homework problem to solve it. You'll be all right. Estimating the what do you call it? The value. Oh yeah, so I'm gonna make sure I can forget the value at risk. I was going to say variance. I'm always on there. That A throws me off. Estimating the value at risk with electronic spreadsheet. Here's what you have to do. Okay, electronic spreadsheet. Here's what's going to come out. It's going to give you the risk and everything else. So the portfolio, the standard deviation. Okay, the change. Okay, when I'm looking at that, here's the Tina Pen, the Swiss mark. Here's my the spreadsheet analysis to apply value at risk. Change. Okay, 1. Obtains a series of exchange rates. That's what we basically did. For all relevant dates for each currency concerned. List the currency in its own column. No problem. Okay, compute the percentages rates over the period. We've done that. From one date to the next for each exchange rate in the column. That's been done here. Okay, next step. Estimate the standard deviation of the column percentage change for each exchange rate. You got your calculator or the software that does that for you. Let's see, down the road at the end we'll talk about a little about the different software. I don't think you're going to have to purchase it, but if I'm looking at the software, you could get like a 30-day trial to see if it works. That's one way of learning it. There's a lot of software. You'd be comfortable with some versus other one. In a separate column, compute the periodic changes of the portfolio value by applying weights to an individual. Okay, we've got that changes, and here's the weights. And then it says use a computed statement to determine the standard deviation in the column, the percentage change in the portfolio. That's what you have in here. So look at it, read it, and see what you have. Now you know what it's doing, and you'll do well. Now here's some limitations of the value added risk. Okay, limitation of VAR is the distribution of the exchange rate movement is not normal. The estimated maximum expected loss is subject to error. And that's some subject. Now here's value at risk. VAR assumes the validity, the standard deviation. Excuse me for a second. If the exchange rate moves are less volatile in the past and in the future, the estimate exchange, the estimate expected is loss derived. You say loss derived, expected loss derived from the VAR or the value at risk method will be underestimated. So there's your errors. Remember we talked about some errors and bias last time. So just reinforcing there is going to be some errors, and we have to understand that no matter what, it looks too good. You're looking at either the best case scenario or the worst case scenario, and you're putting your confidence factor in there. What are the errors or the bias that you think is going to be in there? And that's from your past experience that you think's going this way. Okay? Now, here's the end of the chapter. I'm going to try to do some of this. I got two of this here. Assessing the transaction exposure. Your employer, a large MNC, has asked you to assess its transaction exposure. Its projected cash flows are as follows for next year. So you have that. In Danish krone and British pound. So you have that. Okay, so you have that. Here's the total input coming in, and here's the output. And I've converted it. A current exchange rate in dollars. Assume that the movements in the Danish krone and the pound are highly correlated. They're moving together. Provide your assessment to your firm's degree of transaction exposure, as whether the exposure is high or low. Substantiate your answer. What is your answer? Remember, these are questions. So now think about it. So stop the thing. You go, okay, here's the thing. Figure it out. And now click me back on. And the answer would be here. The exposure rate to each currency in U.S. dollars is divided below. Here it is. You have that plus. You have that exposure rate, exchange rate. So 15. It ends up as correlating the same thing. The krone and the pound values in tangent against the dollar. Both the krone and the pound exposure shows positive inflow. Thus, their exposure should be magnified if their exchange rates against the dollar continue to be highly coordinated. Okay? Very good. I don't know if that helps you any, but it's kind of, I'm going to try to tie this in. Because usually that's what we'd be doing inside the lecture. We'd be going through it in the classroom. So, but I'm trying to keep it in an hour and cover the material. But I may show that for you. So let me just close all these off here. Got a lot going on in this thing, okay? All right, exposures of the MNC's multinational corporation portfolio. First thing, here's the exposure. Measure the impact of the currency exposure. Measure the currency volatility over time. Measurement currencies correlations. Measure correlation and net cash flows and correlations over time. Okay. Okay, let's do measure the impact of currency exposure equation. So here's your equation. Proportion of portfolio value in currency X or Y. Okay. Standard deviation of the percentage change of currencies X and Y. And correlation, coefficient T of percentage changes in currencies in X and Y. Again, the software you put it in there. If you have to explain it, you'll have the formula in here. Okay, so measurement of currency volatility. All right, example. And here it is, different currencies, standard deviation, exchange rate movements based on quarterly exchange rate. You see the difference in the movement. The Chinese yuan, I go yen for Japanese, excuse me. It's all right, there's the yuan there. The peso, the dollar, the France, and the baht. Okay, currency volatility over time. What do we have there? Exhibit 5. Again, look at the charts. Remember, I have it in here. I want you to stop it. Click, pause. Now, those of you who are looking at it, if you're looking at it from Blackboard Course Management System at Harper, it basically had a small, just hit it on the YouTube, and you could make the slides bigger so you could see this, pause it, and print out the sheets if you want. Now, you also have it on Harper, has Harper iTunes University. You have myself, other instructors teaching this course, just may bring it into a smaller sections in the same material. Look at it. It's available. If you're Harper, just go Harper iTunes University, and if you're a Harper student, you sign in with your Harper ID, and you have my classes. You have other classes I've been teaching, and these things. Remember, this doesn't help you much if you haven't read the book, if you have been in discussion and board. This is just an overview at the end. So stop and look at it and make sense. Volatility. Okay. There's a currency that may not remain constant, so from one time period to another, an MNC can identify currencies whose values are most likely to be stable. Okay, So you look at this and see what's going on. Look at the difference, okay, in the financial crisis. Now, measurement of currencies correlations. And I have another exhibit. Again, look at it. I can't spend the time. You look at the pounds, look at the correlation among movements in quarterly exchange rates, what's going on. The correlation coefficients indicate the degree to which two currencies move in relationships to one another. Okay? Which ones are moving in relationships to one another. Okay? Now, applying the currencies correlations to net cash flows. Again, you have this one. And you'll have it, read it, stop it, look at it. And then if an MNC has a positive net cash flow in various currencies that are highly coordinated, it may be exposed to exchange rate risk. Okay? Highly coordinated. So if one goes in a coordinated, it's going to affect the other ones. Okay? However, many MNCs have some negative net cash flows positions in some currencies to complement their positive net cash flows in other currencies. Basically hedging. So when you look at it, remember, my whole thing is the relationships, not as much to make the money. Because, I like to make the money, but then I'm becoming a speculator on that. I want to make sure that I'm hedging enough to have just the right amount of money at the right time. That's my job. And sometimes I make some money, not to lose money. Hopefully I'm always at least breaking even and making some extra money, at least to cover my transition costs. Okay? Now, currencies correlations over time. Because currencies correlations change over time, an MSC cannot use previous correlation. Correlations change around different factors to predict future correlations with perfect accuracy, but it's close enough. Remember, I don't have anything. It's a gauge. It's close enough. It kind of looks like a pound. How do I know? Because I've got it in this container. I'm not sure different content, but it looks like that. So it's close enough. What other tools do I have? There's software. It's giving me, so I'm looking at all these different theories and applying it to using a mixture of some and putting a weighted average on there to see which one has more. And sometimes I may have to change my formula because it's not working well. That's the whole thing. Don't get stuck in a rut and always doing the same way. Something's changing. What worked before is not working now because the environmental forces, the economic forces, or your competition, something's going out there that I can't control, but it's happening, and I should start making those adjustments slowly. Okay? All right, so now what do we have here? Let's go on the other side. We have a few more. Oops, I'm going to move along here. Okay, I got two more. Economic exposure. So let's look at economic exposure as some definition. Okay, so we had these. Let me close these off here. We have transaction exposure. We have relevance. We talked about risk. Exposures of a multinational portfolio. Diversification. And when we're looking at diversification, as we're talking right now about exchange rate, we're talking about different currencies. In currencies, I have to pay in that, so do I use the currencies that I'm using to make sure I have them at the right time? Hopefully they're appreciating, not devaluating, and what's going on. Okay, so what's the definition? Economic exposure indicates any form by which a firm's cash flow will be affected. Okay, real easy. Describable characteristics that would reduce the transition exposure. Currency variability low level is desirable. Variability, so it doesn't change too much and at a lower level. Okay, foreign competition may increase due to currency fluctuation. This could affect the firm's cash flow, but not affect the value of ongoing transaction. Cash flow, but not the ongoing transaction, because I've got the currency already at the right denomination for what I needed to pay the bill for the outflow. Okay. Thus, it represents a form of economic exposure, but not translation exposure. Okay, this is economic, not translation. But remember, translation is a subset of the economic, and indirectly, we're looking at it as an independent entity. Okay, transaction exposure is subset of economic exposure. Well, jumped ahead of that. Okay, Exhibit 9. Exhibit 9. Firm subject to economic exposure. It just shows you. Again, look at the firm. Has a contract to export in which it agreed to accept. The euro depreciates. Oh my God! The contract to import materials at a price in pesos appreciates. Okay, so then the U.S. firm's cash flows are adversely affected if this happens. Remember, when it goes up, down, am I buying, am I importing or exporting? It makes a big difference. Do I want a strong dollar or a weak dollar? Or do I want that currency strong or weak? Do I want the yen, the Chinese yen, devalued? What does it make an advantage to me? Depends on the strategy. Depends on the time frame. Sometimes I say, how long will it work? I don't need it now. Let's hold it off to here. Or maybe I should change something to see if I could move some of my goods out or move some of my goods in, because it's to my advantage. It's part of finance. That's just waiting, playing. You're looking at what's going on in the movement, and you're adjusting the environmental forces for you to make a good strategic decision with your exchange, with your currency or your capital. How much do I need on hand? Okay. Okay. Now Exhibit 10. Again, another exhibit. Exposure to rate fluctuations. Again, local losses received of foreign competition decreases. Depreciation on transaction. Appreciation on transaction decreases. Depreciation increases. Okay. You have to look what's happening here and looking at the MMC, the total MMC. This is a subsidiary. Something's going on. You got different countries, different currencies. How does it overall affect my MMC? Each subsidiary is looking out for its own interests. The MMC has to look over all of it and saying, okay, this is the best strategy, or we should adjust this strategy here. Look at it at what the central bank is doing to its currency, what China's doing, when the stock market they're playing around and not doing too good, and trying to bring that, and the economy is flunking down. And how do I stimulate that? So they're trying to manipulate the economic condition, which has a direct effect on the exchange rate, has a direct effect on the currency, has a direct effect on my operation, my short term, everything we've been discussing. Okay? Okay, so now, the sensitivity of the firm's, could we read this? Let me move this over here. The sensitivity of the firm's cash flows to exchange rate movements. Okay? Sometimes referred to as operating exposure. It should be over here. Okay? And the consideration of all cash flow in a particular currency is not necessarily when some inflows and outflows offset. Okay? Remember, I've got them coming in and it could be within my operation or within the currency as a whole, which affects the exchange rate for that company. I may not have to do anything else because the government's doing it for me. Okay? Only net cash flows are necessary. Okay, so we have this sensitivity to all forms. Consideration of all cash flows is not necessary because inflows and outflows offset, and here's only net cash flows are necessary, right? Coming in, that's what I'm looking for. Economic exposure to local currency appreciation. A. Causes a reduction. Okay, economic appreciation of firm's local currency causes a reduction in both cash inflows and outflows. I'm going to make this a little different when I'm doing the constant math. I'll put it out this way. I think it'll be a little easier to see. Impact on a firm's net cash flows on whether the inflow transactions are affected more or less than the outflow transactions. Okay. Economic exposure to local currency depreciation. Depreciation of a local currency causes an increase in both the cash inflows and outflows. Right? Depreciation, currency is going down, so more cash coming in and more cash is going out. Like it or not, because currency is worth less against the other currency, so I get more of it. Economic exposure of domestic firms. Even purely domestic firms are affected by economic exposure. Even the domestic, what's happening in the economy here, affected. Not only is it global, has an influence on it, like you see in China, we're not buying as much, or buying less, or whatever is going on there. There's a stagnation in the sales, affecting their economy. Then domestically, their economy may keep the engine running, but for how long? And now that's already being affected, so they're already having some effect from the international economic condition, and plus also the domestically within their firm, are affected by economic exposure. Measuring economic exposure, and it says, okay, here's we got two exhibits, so let's just look at them. Here come together. Okay, estimate sales and expenses, Madison, U.S. and Canadian base. Okay, cost of sales, Canadian base. Here's the estimate in millions of units. And here again, exchange rate scenarios from one to the other. You can see the difference. And these are impact of possible exchange rate. These are they're already making some, lack of better word, trying to predict what's going to happen in this scenario, what's going to happen with our currency if it goes up to 80 cents. I mean, the Canadian dollar, right, against the U.S. dollar, all right? Everything's against the U.S. dollar. That's Madison and Units, exchange rate to Madison Corporation, okay? Now, using sensitivity analysis, again, consider how sales and, like I said, stop this, look at it, and take your time. Look at this out and look at it. I'm going real quickly. I'm going real fast on here. I'm already, I think, over my hour, so I'm moving a little faster, okay? Look at it, stop it, look at it, and look what I have underneath here. That's how you learn. Add into your own notes, put it in your own highlight, and once you understand it in your mind, then you'll be able to do well on that. And we'll discuss, like I said, we already discussed this in class. This should be a quick overview. Using sensitivity analysis, consider how sales and expense categories are affected by various exchange rates. Okay, and then using a regression analysis, if you look at regression from statistics, here we have it. Here's the formula: percentage, random error, the intercept, the slope coefficient. Geez, we're almost thinking I'm back in calculus. All right. Okay, here's a chapter question. Now I've got a question. Measuring economics. Now, I'm going to read the question here, and I'll give you the answer. All right, so look at this. Stop it right now and read it. Memphis company hires you as a consultant to assess the degree of economic exposure to exchange rate fluctuation. How would you handle this test? That's all they're saying. Now, here's the answer. Answer, you'd use a regression analysis can be used to determine the relationship between the firm's value and exchange rate fluctuation. Okay. Using the economic exposure. Stocks returns can be used as a proxy for change in the firm's value. Okay, my stocks returns, how many of them sold. Okay, time period can be segmented into two sub-periods, so the regression analysis can run for each sub-period. I'm responding to the question. The sign and multitude of the regression coefficient will imply how the firm's value is influenced by each currency. Remember, you could do a regression coefficient, do it in the YouTube, and somebody, I think there's a couple out there, real easy. Look for the 5-minute ones and just explain it, and then in your mind you understand it, then the concept is not as hard. That's why you like utilizing some of the YouTube. I look at it first, the material is right, but the way they present it is such a simplistic matter. Yeah, it works out well, okay? And also coefficients can be compared among the sub-periods. Always look at the different periods for each currencies to determine how the impact of the currency is changing over time. Okay, so you got your answer. Stop it, freeze it, and look at it. So that's how I would answer it. All right? Okay, so we're doing it pretty good, economic condition. And now we're doing the last one, translational exposure. And here's the definition. The exposure of MNC's consolidation financial statements to exchange rate fluctuation. Here's my statements, my financial statements, my reports, and here's the exchange rate fluctuation. So I'm looking at my cash flows, I'm looking at my balance sheet, but now I've converted it, so what do I have? Brought it back into the parent, into the value of the whole multinational corporation. All right, determinants of translational exposure. Proportion of businesses by foreign subsidies. Greater percentage of MNC businesses conducted by its foreign subsidiaries, the larger the percentage of financial statements items that are susceptible in a transactional exposure. Foreign subsidies, larger percentages of financial statement items susceptible to transactional exposure. Just makes sense. I have more of an impact. I'm out there more in the different countries. I have more of an effect on the exposure. Location of foreign subsidiaries. Okay, so how many locations? Location can also influence the degree of transactional exposure because the financial statement items of each subsidiary are typically measured by the receptive subsidiary's home currency. Remember, each subsidiary is looking at its own to make it good, but how does that part affect the total whole is what you're looking at, the value of the multinational. Is the money going in or money going out? Okay, transactional exposure chapter question. Okay, I put that in here, and that should have been in this one here. Okay, so let's just leave that. I'll leave that open. You can look at it. It should have been Here, let me just close this. Okay, let me just close that here. And this one here has to go over here. Okay? Let's see what I got. Alright? We'll do that next time. I'm not going to do it now. You can just look at the question. Okay, so we took care of that. We're all done on this. Okay, now the accounting method. If I'm looking at the accounting method, what do we got in the accounting method? MMC, transactional exposure, is affected by accounting procedures, many which are based in the Financial Accounting Standard Board. And here they have it. I think I have it in here. I did the link. Oh, here it is. Financial Standard Board, foreign transaction issued, application, has information, project standards, everything you need. Look at the site. I bring it in here. Here's the site. WWFASB, Financial Accounting Standards Board, /summary, and you have the site. It gives you everything you're going to need. Look at it. It gives you information. Read it. Added information. Remember, you may need it for your paper. I know you need it for your paper, so kind of look at that. Okay, close that off. All right, so functional currency of an entity is the currency of the economic environment in which the currency operates. Basic definitions here. The current exchange rate of a reporting date is used to translate the assets and liability of a foreign entity from its functional currency, right? Functional currency to its reporting currency, back to the home, to the parent, okay? Functional to reporting. Okay, weighted average of exchange rate over the relevant period is used to translate revenue, expenses, and gains, losses of a foreign entity from its functional currency to the reporting currency. Look at it, write it down now. Freeze it, write it down, go forward. Okay, translated income, gain, or losses due to changes to the foreign currency values are not recognized in current net income, but are reported as a second component of the stockholder's equity. Okay, highlight stockholder, values, income, stockholder. Remember, I want you to start learning your mind maps. Utilize. I put more words than you needed. It's easier. I'm converting you. As you go to the end, you're going to see very short, brief, boom, boom. What the heck is he saying? Doesn't make sense. It makes sense if you read the material. Okay, here's an exception to the rule. That's what my judge always has an exception. If a foreign entity located in a country with high inflation, exception, it doesn't work. Realized gains or losses due to foreign currency transactions are recorded in current net income, although there are some exceptions. Always exceptions. Remember, always exception. I'm not talking about bias or any kind of errors. There's exception to every rule depending on the host country, depending on the rules and the governmental and what you could claim and what you can't and what is included and what's not. Okay, now 3. Remember, looking at this one here is looking at the counting method. Exposures of an MNC stock prices to transactional effect as any kind of transactional effects. MNC exposure affects as consolidated earnings. It can affect the valuation of the MMC. Okay, remember, it could affect the valuation. If I'm looking at this I'm looking from exposure stock prices to the exchange rate. Okay, prevalent profit and earning ratio. Okay, went down. Signals that concomitant transaction effects exchange rate condition that cause the transactional effect. If something's going on there, the exchange rate changes and affects the stock price in that currency. Remember, we're in a global environment all over, so you have to look at it from a different perspective. It's like I'm working here in Illinois. We got to see what's the laws going on in Wisconsin, what's going on in Hawaii, what's going on in Puerto Rico. It's not a state, but I'm doing a business there. It's a colony, and what the heck is going on? They're going bankrupt. So what's going on there in the economic condition? Do I pull my operation out of there, or do I get cheap labor down the road? You don't know. Remember your strategy. What do you have to do? Okay. Signals that a competent transactional effects, exchange rate condition called transactional effect, can also cause changes in unexpected cash flows in the future, in and out. Hopefully it's not out. All right. Such changes could influence the stock prices, exposure, managerial compensation, transactional effect. NMC stocks may be subject to transactional effects, and managerial compensation is tied to MNC stock prices. it's always the stock goes up. That's why a lot of times you really look what's going on in the U.S. We're not really long term because we short term because the manager, the president may not be there. May only last a couple of years. He's ousted out by a new board, or you have a lot of investors are coming in that want to change the board, so they buy enough of the stocks because they're stagnant, and now they have the power because when they do the votes, they could bring in new board members that will fall in line to what they want. Okay, question on chapters that affect the firm's transaction. Let me see, I'll put this one on here. What factors affect the firm's degree of transaction exposure? Any kind of transaction exposure. Explain how each factor influences transactional exposure. Okay, answer. The greater percentage of business is conducted by subsidiaries, the greater the transactional exposure. The more I have, there's more transactions going on there. I have more exposure. I have to minimize that. I have to look at, I may hedge one country over another country, or I may one currency over another currency. It's something you have to look at strategy, what's going on there, or I may just leave the money there and just hope that it's not losing money as long as I keep it there. I mean, I pull it out, it's worthless out here, but I'm waiting to see that something changes in the overall financial environment. Okay. Greater variability of each relevant foreign currency relevant to the headquarters, the home, the parent reporting currency, the greater is the transactional exposure. The greater variability of each foreign currency relative, right? Because if I have in one area, let's say an Asian market, I kind of notice the economic effect in going there. But then I had the European market, then I had the Middle East market. One is more vital than the other, all right? So it's more unstable. So what's going on? How do I handle this? Okay. The type of accounting method employed also affects the transaction expenses. Okay, so those are your answers. Okay, so we're good on this one. We're good on 5. Now to the summary. What do we have here? Let's look at the summary. We're almost done. Phew. Okay, MNCs. I got everything else here. Here's a summary. Number 1, MNCs with less risk can obtain funds at a lower financing cost, right? Less risk. It's no different. I'm not a credit risk, so I could get a better deal. The higher the credit risk, the higher the risk. It could be economic, it could be competitive, it could be just regional, whatever it is. But the risk is in there. I have to pay a higher cost for doing business in there. They may experience more vital cash flow. Okay, because of the exchange rate movements. Exchange rates can affect their financing costs. Okay, thus MMCs recognize the relevance of exchange rate. That's the next one. They may benefit from hedging their exposure. You have to hedge. Remember, I'm not gambling like a speculator. I'm trying to make out so at the end, I break out even, making some money, but the relationship is still handled. Transactional exposure. Okay, is exposure at the MMC's contractual transactions to exchange rate movements. That's all it is. Transaction is looking at my exchange rate movements. Or this one is any kind of transactions when I'm looking at the other one. Okay. The transactional. Okay, MNCs can measure the transaction exposure by determining the future payables and receivable portions in various currencies, along with the validity of the levels of the correlation of these currencies. How stable are they? Okay, now they can access how the revenues and costs may change in response to various exchange rates. Okay, so I'm looking at here. Now I'm looking at any exposure MSC cash flows, direct or indirect exchange rate movements. MSC can attempt to measure the economic exposure by determining the extent to which their cash flows will be affected to the exposure to foreign currencies. It's attempting. Remember, you don't have the crystal ball. You haven't traveled. You're just doing it. You have that feeling. You know what's going on there. You're in it. A lot of times you're in an environment. You could kind of tell. I travel a lot, so when I'm in different neighborhoods or anything else, you could tell if it's a good neighbor or bad neighbor. Right? Just that vibe. And who could tell? Well, that's your intuition. Yes, it is, but it's different things. I'm picking up different signals, and that's what happens, right? You got different reports. You're looking at it, and then you still remember you got intellectual intelligence out there, but you're still the one that's going to take all that information and say, here's the probability, but I think it's going to go this way because no one knows the future yet. Okay, transnational exposure is exposures how embassies consolidated financial statements to exchange rates. Okay, how to measure transactional exposure. Again, embassy can forecast the earnings in each foreign currency and then determine the earnings affected could be affected by potential exchange rate movements for each currency. Whew! You got that done there, huh? Pretty good. Now remember, you're doing well in this class. You're not. I'm not going to be asking you too many. You're going to be doing formulas and problems in the classroom, but not in the exam. You have enough to learn the concepts here. Make sure you know transactional exposure. Okay, it's more with the exchange rate, transaction, translational. Whew, my tongue is twisting. I've been already talking for more than an hour with no drink, so I should be okay. All right. So anyway, this is Finance 225, International Finance Management. We're covering measuring exposure rates to exchange rate fluctuation. Has a big thing that you found out on my stock prices, on my currency. You look at the currency as a commodity. How much do I have it, and when do I get more of it, or when do I get rid of it because it's worthless? And how do I get rid of it? You know, I'm buying or selling. What's the other economic factors that's out there? How do I measure this? What's my portfolio? How to reduce the exposure of the exchange rate in my portfolio because I'm a multinational. You know, if you got one country, you're already stuck. But you got several countries, you try to hedge one over the other. So you remember this relationship. You're not a speculator. You're trying to make sure that you have the right money, maybe make a little bit of money, but you don't go over because then otherwise you can start taking that added risk. And your whole job is to make sure you have the right cash at the right time to take care of your capital, your short term. Sometimes short term you have it to make some money, but it's all planned strategically, so you utilize the money to make money. All right, so my name is Dr. George Mochocki, and you're taking this class online or face-to-face class at Harper College. And if you're not, then you just pick this up on the YouTube because some students like it. It's easier for them to read. Sign up to classes or go to your local community colleges. You'll take this class, and it'll be a good introduction class. Gives you some international exposure, which is good when you're looking at the job market because we are working in a global environment. You're operating locally, but thinking globally in most businesses, that is a plus. So I'll see you in the next chapter. Bye. Hopefully it's underneath an hour. Keeping my fingers crossed, but I think I went over a little bit.